We have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. A lot of people say to me, who was your mentor? And I never really had a mentor per se. I mean, it was mostly reading and studying, starting at Chicago before I started work. But I did learn a lot by experience. One of my favorite sayings is experience is what you got when you didn't get what you wanted. And so, the experience of losing 90% in the growth stocks was very educational. And the experience of making money in the high yield bonds was very educational. John Kenneth Galbraith was one of my favorite inspirations. And he wrote a book that I read early on called The Short History of Financial Euphoria, which talked about cycles in euphoria, so the ups and downs of psyches, which are very important. And that book had some very, very important quotes, which I use all the time. One is that we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know, which I believe in very strongly. And then another is what he says about one of the dominant characteristics of financial markets being shortness of memory. And, people just always forget the lessons of the past. And that is what causes cyclical occurrences to repeat. If people understood and remembered and avoided their tendency to go to excess, then I think the cycles of the world would be much more muted, but they don't learn it. On the one hand, we have prudence and memory, and on the other hand, we have envy and greed. And most of the time, greed wins.
Yeah.
Charlie Munger, who is one of my inspirations, always quotes the philosopher Demosthenes, who said, "For that which a man wishes, that he will believe." So most people, if you show them a scheme and you tell them it'll get them rich without much risk, they'll take it up. But my son wanted to be in the investment business, so he went off to college, and he would come home and you should say, "Well, we should buy Ford stock because Ford is coming out with a great new Mustang." And my answer was always the same. Who doesn't know that? The point is that the things that everybody knows are already in the stock price. So if you know something and you say, "Oh, that's going to make the stock go up," you should think about whether everybody else knows it and have already incorporated in the price. If you think the same as everybody else, you'll behave the same. And if you behave the same as everybody else, you'll have the same performance. The goal is to outperform. So thinking and behaving the same as everybody else cannot be the route to success. Rather, you have to think differently. You have to see things differently. You have to perceive some information differently, or interpret it differently, or analyze it differently. And only if you do that can you rise above average performance. Now, you can't think differently just for the sake of being different. If most people say, "Well, it's probably going to be the weather tomorrow is probably going to be about the same as today," you can't say, "Well, just a minute, if I'm going to be successful, I have to be different, so I'm going to say that I think that the weather tomorrow will be either 20 degrees hotter or 20 degrees colder." It's not a winning approach. You have to do it for good reason, but you have to think different. And you have to think better. So if you try to be different in your thinking, but it drives you to think worse, to more erroneous conclusions, that's not a way to success. Different and better. So an example is very simple. The first level thinker says, "This is a great company, we should buy the stock." The second level thinker may say, "It's a great company, but it's not as great as everybody thinks it is, we should sell the stock." That's an example of second level thinking at work.